Who's afraid of European banks? Welcome to our Debt Talk episode. We want to talk about the European banking sector. We want to ask if European banks are walking dead zombies that will affect the real economy and potentially lead to a subpar recovery from the pandemic, or maybe even another financial crisis. We want to ask, why is it that European banks find it so hard to get healthy, and what vaccine is needed to make them more resilient? Welcome all. I'm Moritz Schularick. I'm an INET Fellow. And today we're joined by our partners from Berlin, the Forum for a New Economy, and a joint INET Debt Talks and New Economy Shortcuts conversation. Joining me as a co-moderator is the director of the Forum for a New Economy, Thomas Fricke. But before I hand over to Thomas for a quick introduction, let me introduce INET's private debt initiative. Set up 2 years ago, we want to explore the causes and consequences of the strong rise in indebtedness of households and companies and its implications for the economy, for inequality, and for financial stability. In our Debt Talk series, we want to reach out to the interested public and present state-of-the-art lateral thinking about the question of debt, new economic thinking. And we'll also have a book coming out this year that unites a fantastic group of authors and analyzes what the consequences of high debt are. So stay tuned. We'll have upcoming events with the authors. And now let me hand over to Thomas. I'm looking forward to this Debt Talk. Thomas, please.
Thanks a lot, Moritz, and thanks for the introduction. Just to introduce briefly, I'm the director of the Forum New Economy in Berlin. It's a Berlin-based, as it seems, a Berlin-based platform, which is designed to bring together innovative thinking, new economic thinking, policymakers, the German public, and a bit abroad, also in Europe, which seems, given the topic of today, very interesting. And as we followed the debt talks for a while now, and we're very fascinated by these, we wondered if it makes sense to bring together these initiatives and to have a common event on the very specific European situation. That's what we are talking on today. And it's particularly important, I think, for Germany, because if we're talking about financial and instability of the euro in Germany, it's more talking about public and governments and very little about private debt and private partner banks. And so it's hugely important to bring this debate to Germany. We're very happy to have you at the podium. So Moritz, you may pick up and introduce. You're muted. Moritz, you're muted.
Sorry, I was muted, the usual one. So I'm very happy to introduce our guests in this joint Debt Talk. We're very pleased to have Martin Arnold. He's the Frankfurt bureau chief at the Financial Times and a former banking editor of the same newspaper, the Financial Times. So he's followed the sector really for a long time, and we're very much looking forward to hear what he has to say. We also have Elena Carletti. She's a professor of finance at Bocconi University and the founding director of the Florence School of Banking. She's also a member of the European Systemic Risk Board. And last but not least, Richard Wake, an INET board member, the Secretary of Banking and Securities of Pennsylvania, among other roles, and the author of a forthcoming business history of the US. And we're all here to discuss who's afraid of European banks. Let me start with Martin and our introductory statements. And as we go along, we will weave in Q&A from the audience. We have time reserved at the end for a lively debate with you, but we're also going to weave in the question, Thomas and I, when they come along. And after the opening statements, we will have a lively discussion, I hope, between our panelists. But let me start with Martin and ask you for your opening statements. Martin, you've followed the situation for a long time. What's up with the sector? Are we in a financial episode of The Walking Dead?
Well, let me start by saying I've worked for the FT now for over 20 years, and much of that I've been covering finance, including through the last financial crisis in 2008, 2009. The last couple of years, I've been here in Frankfurt covering the European Central Bank, and clearly still keeping a close eye on the banking sector both as a transmitter of monetary policy, but also from the financial stability point of view. The banking sector was the source of the problems in the last crisis. But in this crisis, you've heard a lot of people saying that actually the banking sector has played more of a constructive role than a destructive one. The banks came into this crisis in a lot better condition than they were a decade ago, with much stronger capital levels, but also much better liquidity position. And that's thanks to a lot of the reforms that were introduced since the financial crisis. So despite the massive shock of the coronavirus pandemic and the record post-war recession that caused across the global economy, and particularly hard hit was the Eurozone economy, the banks have not been a transmitter of that shock. They've been an absorber in some ways, because they actually increased their lending to their customers in the early months of the crisis. Many of the European companies drew down their revolving credit facilities, and banks, provided those loans, provided that extra capital that the companies needed to deal with the shock of the crisis. And I've got some figures here that I'll just to put some figures on this and put it in context. I mean, these are from the ECB's latest statistics on banks which came out last month. The banks had a common equity tier 1 capital ratio, which is the main benchmark of balance sheet strength, was 15.2% in September in the Eurozone, up from 14.4% a year earlier. And non-performing loans, which have been a big concern for the past decade since the last financial crisis, have fallen from over $1 trillion to well below 500 billion. And they're actually 485 billion in September. And the non-performing loan ratio has come down dramatically. Now, that doesn't mean that the banks are out of the woods, and it doesn't mean that we shouldn't worry about the banks. But I just wanted to put it in context and say some of the positive things, because there are also negative things about the banks in Europe and reasons why we should be worried. The banks have basically been shielded from this crisis by an incredible amount of state support. The governments have guaranteed a lot of the lending that they've been doing to companies, and also there's been huge usage of debt moratoria, which means that the ECB said that more than a fifth of Eurozone banks have over 10% of their loans under moratoria or other forbearance measures as of the end of last year. In Greece, it's about 15% of all their bank loans are subject to moratoria. So, and clearly other state support measures that have been introduced, such as the furlough schemes, the short-time work schemes, have been hugely beneficial for the banks, because they've meant that people have continued to receive an income. They haven't lost their jobs. There hasn't been a massive surge in unemployment. So therefore, there haven't been huge defaults. So basically, the governments have spent a huge amount of money to put the economy in the deep freeze, and that has shielded the banks to a certain extent from this crisis. So we still don't know yet what is going to be the economic scarring, the economic impact from this crisis, and therefore we don't know whether the banks are going to come through it in great shape. But they aren't. There are several areas where they aren't in great shape. Just to finish off, and one of those areas that worries worries people at the ECB, it worries supervisors, and it should worry all of us, is the profitability of the Eurozone banking sector. And just to give you a few more figures there, overall return on equity, the biggest Eurozone banks dropped from 5.2% in 2019 to 2.1% by September last year. And that was mainly due to more than 100 billion euros of impairments and provisions for bad loans, which knocked down their returns. But even the 5.2% they were doing before the crisis is not enough because it's well below their cost of capital. So that means that investors are basically losing money by by investing in Eurozone banking for the sector. And the answer, well, we can come to that later, but the answer most regulators think is for more consolidation and more cost cutting among the banks. And that's going to require some serious progress on Eurozone banking union and on areas like capital markets union. And I'll shut up there because that's plenty to be cracking on with. But that's an overview of where we are in the sector.
Thanks a lot, Martin. Elena, you're not only an excellent academic and knowing financial markets from that side, but also in the board of directors at the UniCredit. So you have a mixed view on this. Would you agree that maybe there are good signs that banks are out of the wood in Europe? And what is your take on this question?
Thank you, Thomas, and thanks. Good evening to everyone, and thank you very much for having me in this interesting panel. So my perspective is not that different from what Martin, I think, said in his introductory remark, but maybe let me make some different remarks so that we can have more discussion. I think when we're talking about are the banks out of the woods, we need to distinguish a little bit the phase we have in mind. So I think we need to distinguish before the crisis, before the COVID crisis, now during the crisis, and then afterwards in the more medium to long term. So as Martin said, the European banks enter in the crisis in a much better shape than how they were before the global financial crisis, in particular capital-wise. But as Martin also pointed out, they had a very chronic disease, which was the one of low profitability. And this is not going to go away. On the contrary, this problem is going to stay during the crisis and during the COVID crisis and after the COVID crisis. And that is really what is, I think, the dragging feature of the European banking sector. And it has been for the last 10 years. We can discuss afterwards why that is the case, why that is different from the United States, for example, where banks are much more profitable. But that is, to me, if I had to say before the COVID crisis, what is that was worrying me the most was precisely the low profitability, because that is dragging then into the price to book ratio evaluation, the price to book values. And you could see that the European banks had all price to book that was below 1, with very few exceptions. Whereas all the banks in the United States, at least the major one, they had a price to book about 1. And why is that important? It's not so much because we want the shareholders of banks make money and get away with lots of money. That's not the point. But the point is that we need to have a sustained level of profitability, because otherwise banks will not be able to maintain capital and even more to attract the capital if they need to. So why should investors invest, as Martin said, now in the banking sector is not at all clear. So this was the problem before the pandemic, coupled with the additional problem that the banks were facing very intense competition from non-financial intermediaries, in particular from fintech and big techs. Is this now a bit better? I think yes, this is a little bit better, because in the few months, the very first month of the pandemic, you could see banks make huge steps from the digital perspective. Banks were very able to transform their business from physical presence to online very, very rapidly. So I can tell you, UniCredit, I think they made in 2 months what they were supposed to do almost in 10 months, if not 1 year, in terms of digital progress. So this is something that banks will keep with them. So this is something that will favor them going forward. And maybe it will also shield them a little bit. If they are able to go in this direction even more, they will probably able to keep this advantage with them also later on. And now let me make one final remark, which is the point of non-performing loans that I think Martin has said, and rightly so. Banks have decreased their non-performing loans massively before the COVID crisis. Of course, the big question now is to which extent these non-performing loans will grow again. We had moratoria, we had public guarantees, but these are still a small number relative to the stocks of loans banks have on their balance sheet. So what's my view in here is that it very much depends on their provisioning policies. So how much are they going to set aside? How much are firms on the one end able to transform themselves and not to default? So how long also the support measures are going to stay? But from the side of the banks, what they need to do is to set up provisions. Remembering, though, that provisioning is good on the one end, because, of course, it avoids a cliff effect, it avoids, in principle, it should also avoid zombification, because if the banks have already provisioned, they should be more willing to interrupt unprofitable relationship. On the other hand, however, what worries me, and maybe this is a point which is slightly more technical, but let me make this as a final statement. What worries me a little bit is that in the moment when banks provision for loans, what are the incentives to undertake workouts of the loans? Because the easiest solution for them once they provision would be just to sell the loans. But remember that these NPL are going to be very different from the ones we had before, because before we had NPLs that were mostly coming from mortgages. Now we were going to have eventually NPLs that are mostly coming from SMEs loans. And these loans need a different recovery process and different workout processes. And the question is whether banks are equipped for it and how provisions interfere in a way with the incentive they may have to handle NPL going forward. And let me stop here.
Excellent. Thanks so much, Elena. Coming to over to Richard, looking at us Europeans from across the Atlantic. Richard, with your background both as a banker and as a regulator, what is it that we Europeans are not getting right? What is your take on the situation?
Well, Moritz, first, thank you, and thanks to my co-panelists for their excellent, insightful comments. I would say, Moritz, that the story's a little bit different depending on which country you're looking at. Europe's not a monolith in that regard. Bad debt is and always will be the most important factor in analyzing a bank. In Europe, with fourth quarter earnings releases, we hopefully see a light at the end of the tunnel for COVID-related issues. And the verdict seems to be that the government's providing enough support. I think we all know and agree that European banks have been slower in dealing with bad debt and new capital. And those are challenging issues because of all of what my fellow panelists have also already said. But at the same time, the industry and the regulators are hyper-focused on this. So my own view is that they're going to work through these issues with all the mechanisms already mentioned. So that brings us back to a more fundamental issue, which to me is trends in aggregate private sector debt growth. High government debt is generally not a factor in giving rise to bank credit problems. Instead, rapid growth in private debt has always been the best leading indicator of these credit problems. By that measure, the banking industry in most European countries, while not necessarily in great shape, is not on the verge of crisis, and in most cases is at least in reasonable shape. We would also note that Europe generally has a favorable net export and current account surplus position, which structurally is a huge positive for the banking sector. The biggest exception on both these counts, rapid credit growth and trade deficit, is France, where private sector debt is skyrocketing and has reached 215% of GDP. Most of the rest of the major countries in Europe look very different. The UK is at 154%, Spain's at 150%, Germany's all the way down at 114%, and Italy is all the way down at 110%. Now, keep in mind when it relates to France that rapid private debt growth feels good in the short term. But if sustained, overly rapid growth creates overcapacity and credit problems. So the situation in the French banking industry is the one we're going to watch most closely. Spain and the UK have issues, but credit problems seem contained. In Germany, domestic credit issues are well contained. And private sector debt growth, after having been very flat for a long time, frankly contracting a little bit, is finally trending up. So we're optimistic in the short term about German banking trends with only minor exceptions. Italy, where so much current focus, concern is focused, it does have very high government debt, which constrains it to a certain extent in terms of the government's ability to provide support. And it does have banks that have been slow in buttressing capital, and it did have the bail-in issue. Nevertheless, has a couple of real positives. It has relatively low aggregate private level debt levels, which to me means upside for the lending community there. And, a generally favorable net export status in the last few years in contrast to the 2000s. So those fundamental factors should help it cope with all the issues it's facing. So again, we're generally sanguine about Europe, but France is the one we're going to spend most time watching over the medium to longer term.
Fantastic. Thanks so much, Richard, Elena, Martin. Let me follow up on one question, but then also feel free, please, to react to each other, and Thomas and I will moderate the discussion and the Q&A from the audience. But let me follow up on one point. The Institute for New Economic Thinking is hosting this event. So as an economist, I'm asking myself the following question. Two of you mentioned the low profitability, the low return on equity, the low cost of banking services, the lack of concentration, the level of competition that means that European banks are not as profitable as their American counterparts. So as a consumer, I'm asking myself, do I really worry about that? Why I get the same banking services in Europe that I get in the US and I pay much less for them? That is the reason that banks are less profitable, because there's more competition. And from a consumer point of view, that should be good. So let me ask the question this way. Why do we worry about low profitability? Isn't that a sign of good health and competition and a market as it should be? To everyone, Martin, Elena.
Well, I think that's a very German.
Who wants to take it?
Question. Oh, yeah. I'll very quickly say I think that's a very German question because it's you're betraying your national roots there, Moritz. I think because Germany has designed its post-war banking system to be split between the cooperative banks, the private sector banks, and the state-owned Sparkassen banks and Landesbanks. This sort of three-pillar system, which is deliberately designed to maintain competition and keep margins very low and prevent any bank from getting too profitable. And that makes sure that German companies in particular and households are able to maintain cheap access to financing. And that's obviously an advantage for Germany, but having such a structurally weak banking sector isn't a great advantage, as was shown when Germany had to bail out several of its biggest lenders after the financial crisis in 2009. So I think, yes, from a consumer point of view, you might say, well, competition is great and it's really healthy, but not if your banks are unable to invest the amounts that they need in technology, not if your banks are unable to provide pan-European banking services, not if your banks need to be bailed out by governments and are unable to provide enough credit to your economy because they're weighed down with low profitability and excessive non-performing loans. So there's definitely two sides to that argument, but I'm very interested in the Germanic angle there of your question.
Maybe, Richard, you can tell if you're happy as a US citizen to pay much more for banking services.
Yeah, I would respectfully disagree with the idea that there's not similar competition in U.S. banking. And one of the ways that retail banking is just one part of the whole equation. I think there's plenty of competition there from non-banks, especially these days. I think it's also true if you look at the U.S., the banking sector only provides about a third of all the private credit extension in the U.S. So non-banks, all the way from, all different types of lenders, business development corps and corporations and the like are providing ample competition. So I think of this as a very straightforward issue. I view profitability as boiling down to very tough decisions at the management level in Europe that need to be made. Some of those decisions were alluded to by my colleagues here. Business combinations is one of those. Paring out less profitable lines of business is another. And it's not just one, it's many, and it's tough. But that's management. And you've got to do that in this case. You've got to have the proper trend in profitability, or you're not going to be able to solve your capital issue. Folks don't want to invest in businesses that have low profitability and low growth, which is kind of what the Europe situation is right now. People like to invest in businesses that have good growth and good margins, and banks, and both those things go hand in hand. Growth provides earnings. And that's one of the issues in European banking. I was reading several investor presentations from some of the banks in preparation for this panel. And some of them didn't even mention loan growth in the entire presentation. And that's the raison d'etre of a bank. And that's, I can't imagine giving a banking presentation without talking about trends and potential trends in loan growth. So I think there's a lot there, but I think it boils down to good old-fashioned management.
I don't disagree with anything of my two other co-panelists have said. I think it's not a matter of ripping off customers. I think it's a matter of having a sector which is healthy, which can innovate, which can absorb shocks. Because in case of shocks, currently the banking sector of course, has much less capacity. So it's a matter of having a sector that is an attractive sector for investment. And as I said before, not because we want shareholders to be rich, but we want a sector that is able to attract investors, as any healthy sector should do. Let me say, banking has become a very good investment for fixed income investors. There is a lot of it. The fixed income investment is very attractive in the banking sector because now banks have so much equity that for a fixed income investor is really good, but not for equity investor. And I think this is not a healthy system.
Martin, you had another question to Richard, I think, on French debt levels.
Yes. Thank you for letting me ask a follow-up. Richard, I'm just fascinated to hear your point about French private sector bank debt, or not bank debt, but French private sector indebtedness. And I wanted to follow up on that. I don't know if you know this, but I wondered whether that is something that has increased recently, very sharply, or is that historically, has France always had this high level of private sector debt? I thought that the Netherlands, to be honest, was the country in Europe with the highest level of per capita private sector debt. Maybe I don't know if you have the figures for the Netherlands, but I'm just very interested as to whether the French indebtedness has increased since the pandemic hit, basically, and whether that is as a response to that, and whether it's in the corporate sector or if it's household debt as well.
In France, let me talk about the Netherlands for a moment first. We see, and I don't want to call the Netherlands small, but let me call it smaller. And we see several economies in Europe. I can think of three that have very high debt levels, just as you express. Luxembourg, the Netherlands, it's 250% or more. Those economies also tend to be the ones that have extraordinary trade surpluses. And in my analysis, those two things, for high debt to be sustainable, you almost have to have a high trade surplus. And it really reflects kind of a fact that your business, the scope of your businesses really is more pan-European than domestic, I think. So if I can just focus on the 4 or 5 largest European countries, France has the highest by far at the number I mentioned, 215 number I mentioned earlier, and it has a slight trade deficit. So it's not as protected from this. And we don't think a trend that's 1 year old is necessarily that indicative. We tend to look 3 to 5 years into the past. And yes, France's private debt to GDP growth over the last 5 years is 20%. That's private debt to GDP today versus private debt to GDP 5 years ago. It's 20%. That's kind of borderline concern territory for us. And it seems to be distributed in France's case on both the household and the corporate sector. Looking at it here, that growth in the business sector is 27% or 24%. On the household sector, it's 67% in the last 5 years. A lot of that is mortgage. So all those really beg for attention from my perspective.
Very interesting. Thank you.
Great. Let me channel a question from the audience. Sander Lammers asked 2 questions, but I'm going to combine them and then open them up into one. So the first question is, how do we think about a European, sort of the European framework for banking sector activities, for lending? One example would be there is no European, sort of Europe-wide insolvency and in corporate debt reorganization framework. So my question would probably be, let me open it a little bit and ask you, if you had a magic wand, what is it that you think is the key to unlocking growth, integration, and consolidation in the European banking sector? And what role do you think institutional legal structures such as insolvency frameworks or different mortgage regimes, etc., play in preventing the emergence of a truly European banking union? To anyone who wants. I'm looking at Elena particularly because she has done amazing work on these questions, but Martin as well. Very closely.
No, I can start if you want. But your question is really what should unlock European banking? So why don't we have a European banking sector? I think the question is not so much, the problem is not so much about the insolvency, the bankruptcy regime for corporates. I think it goes beyond that. I think the reason why we don't have a pan-European bank so much is because there are not many economies of scale in having big international banks so far for various reasons. But one reason it also has to do with the political factors, with the ring fencing, for example, from regulators and particular supervisors. Banking groups in Europe cannot reshuffle easily liquidity and capital, even within the banking group, because of this ring fencing attitude. So I think these are elements that, in my view, go beyond corporate insolvency regime and the fact that we don't have a unified corporate insolvency regime.
I think Elena is exactly correct in saying this. That is a huge issue that will persist. But I do think there's merit in the idea that was suggested that improved regimes for managing the resolution of problem debt, to my view, even when those don't work in the favor of the banking industry, do result in cleaner, more honest balance sheets for all concerned. And really, banking is a reflection of the health of the businesses and households in the community it serves. And better debt resolution for problem debt cleans everything up faster, and I think is a huge positive that can stand significant improvement, frankly, in Europe and in the United States.
Elena, you've been discussing in a recent paper just this question about bad banks, and should it be at the European level or national level? Perhaps you can give us an insight on what you would prefer.
I would very much prefer European level, but for the simple reason that I had to smile a little bit before. All of us have a national prejudices or point of view. So Martin said to Moritz that he had a German view when he was asking about competition in the banking sector. I had to smile instead when I heard Richard say that the public debt levels are not usually the problems, but they are more the private debt that induces the problem. Because as Italian, you can imagine that I stay on another experience, which is that our really drag on the economy is the public debt levels. So starting from this perspective, if you ask me what about the EMC, do you want it at the private, at the national, on the pub or the European level? My answer is the European level. Because I can see that in Europe, what we really miss is sometimes a level playing field for different fiscal space across countries. And I'm not suggesting here that we go for full mutualization of everything. This is not what I want to say. But if we want really to restore, in particular in the banking sector, a level playing field, we need to break this nexus between banks and their sovereign, which is perpetuates again and again. So definitely at the European level.
Perhaps Martin would
let me. Oh yeah, perfect.
Yeah, so I won't repeat what the others have said, and I agree with both of them and the points they've made, and particularly Elena's points about it being more than just bankruptcy. Corporate insolvency regimes need to be harmonized. But what I would just like to maybe make an optimistic note here is that for years, it feels like we've been talking about the need for Europe to complete banking union. And I think that gets to heart of a lot of this, because once you have completed banking union, you have a single European deposit guarantee scheme that everybody trusts and everybody is subject to, then that should allow for the free or much freer movement of capital and liquidity across borders, which Elena was talking about being one of the big problems that's holding back development of a pan-European banking system. Because at the moment, if you're a customer of a bank in Germany, as I am now, you find it still incredibly difficult, even though France and Spain and Italy have the same currency. It's incredibly difficult to have. There's no sense of harmonized banking system. There's no sense of a kind of easy transmissibility of money or payments, or when you travel to make payments. Each country has its own, for instance, its own system of payment cards, which don't work in other countries. France has the carte bleue. In Germany, they have their different system. So this is really but those kind of things I think would break down once you get developments on the Eurozone banking union. Now, why am I optimistic about that? One word: Draghi. So Super Mario is somebody who is a big believer in this. Mario Draghi, for years as president of the European Central Bank, was droning on about the need for completion of banking union. And now he is Prime Minister of Italy. So he is in a perfect position to push forward this rather than acting as an obstacle, which Italy has, to be fair, been in the past, to political agreement within Europe to push this forward. And I think you'll see that. I think you'll see Italy work much more constructively with Germany and France, the key political powers in Europe, to reach agreements on progress on banking union. And that could be, it'll take some time, but in the next few years, that could be transformational for the Eurozone banking system. So there's a positive, upbeat note for you.
Great, thank you, Martin. I want to go in a slightly a different direction, but of course we're talking about the European banking sector here. The pandemic has clearly been a challenge for corporate balance sheets, but also for banking balance sheets. But there are, except for sort of the short-term crisis management or pandemic management questions, there are longer-term challenges. For example, related to climate change. So what do you think? There's a big debate in the community about green finance, about the role of monetary policy in helping the transition to a call it greener economy. What do you think? Big picture, can finances, and especially the European financial sector's role, be in that transition? How do you see that? How do you see that debate here? Maybe Elena, Martin, Richard, whoever wants to go first. Finance, green finance, and Europe going forward. Where do you stand?
Yeah, perhaps I can start by mentioning what's going on in the U.S. in that regard, and that is that climate change risk is at or near the top of mind for Treasury Secretary Yellen. I came across this over the last year or so, even before Biden was elected and she was named Treasury Secretary. But when you talk, whether you talk to the Fed or you talk to the senators that are on the Finance Committee, or climate change is very, very high in people's consciousness, and the risk associated with that. And what the Fed has proposed, or the Treasury has proposed, I guess they both have, is starting to do some light examination around portfolio of risk associated with climate change. So, it's in the very nascent stages, but the presumption is banks are going to have to start reporting risk, presumably at a company by company, loan by loan level, or certainly by the sector level, on what kind of risk and might be associated with given loans to given industries. That would suggest that sometime in the next few years, that could seep its way into capital requirement calculations. Well, if all that comes to pass, that makes a difference. Money talks, capital requirements talk. And that would suggest that folks would start deploying more lending power into the green sector and be a little more reluctant to do it in some other sectors, notwithstanding what Brian Brooks, I believe his name is, did at the OCC under Trump. I think the banking industry will have an influence in that regard. I always think of Europe as being ahead of the United States in that regard. So I can't imagine that won't also play out in some way in Europe.
Elena, I'll be curious to hear what you think.
Yes, I think I tend to agree with what Richard said. Climate risk is clearly at the top of the agenda right now. Now, where banks are vis-a-vis that at the moment is still very much driven, in my experience at least, by what regulators are sort of telling banks that they should do. So the fact, as Richard was saying, that there will be an examination of the risk in the portfolio from a climate perspective, and there will be a stress test on climate risk, induces banks to really get going on this. How much they do it on their own initiative that goes beyond that, I'm not quite sure yet. But certainly they follow what institutions are requiring them to do. So if they have to do disclosure on their portfolio, and if they have to start looking really at risk much more carefully, they will, and they are doing it. You also asked Moritz about the role of central banks. Of course, monetary policy can also play a role in here. So, for example, through the collateral framework, I was the other day in a reading group with a PhD student, actually from Cologne, that attends my reading group in Bocconi, and he was presenting us a paper showing that every time one of the executive board members of the ECB has made an announcement about something about green bonds in favorable treatment within the collateral framework, on the shooting skyrocketing high. And funny enough, there was no price indifference of green bonds before this announcement. So you can see the impact that the institutions and policy can really make to make the change. So if they want to do it, that would be a good avenue.
Martin, should the ECB green its monetary policy? What do you think? You cover the ECB as well. What's your stand in that debate?
I think that is too simple a question. If you forgive me for sort of sitting on the fence here, there is definitely a desire from Christine Lagarde to make the ECB much more proactive on climate change. They are the ECB is in the middle of conducting a review of its strategy. The results of that to be announced in September. A week ago, they had their first session of the Governing Council to discuss climate change. And I spoke to some of the council members after that, and I wrote a story that was in Monday's Financial Times. You may or may not have seen it. Essentially, for me, at the moment, that while there's a lot, central bankers actually in Europe love to talk about climate change because it's an easy win for them. It's very popular. They can make kind of bold statements about it, but I don't think we're going to get to the point of what a lot of the campaigners are hoping for, which is green QE. In other words, the European Central Bank selling the bonds of corporate issuers that it's bought that are considered brown and only buying green bonds. I think if that ever happens, we are an incredibly long way away from that, because I just think that's going too far for an inherently conservative institution like the ECB. But having said that, there's a lot they can do between green QE and nothing. And I think they will do a lot. And I think most of the action that really matters will be in the financial supervision side. So it's the supervision of banking side, where they can stress test the banks, which they're doing. They can require the banks to improve their disclosure of the climate risk in banks' own balance sheets, which, as you've already said, will require banks to require their customers to disclose much more about their own carbon footprint. And at the moment, the banks are doing nowhere near enough on it, and they don't want to, because they know that there's quite a lot of coal-fired power stations and coal mining companies that they have a lot of exposure to on their balance sheets, and they're uncomfortable about how that looks in public. So they don't want to disclose this, but they're going to have to. And the central banks will force them, and then the market will do a lot. I don't think I hear what Richard's saying about heading towards capital requirement changes. Again, I sense quite a lot of reluctance to go that far from the top officials at the ECB that I talk to. Whether it's a green favoring factor or a brown penalizing factor, because you can do capital requirements both ways. You can up the capital requirements for brown, so-called climate risky assets, or you can cut the capital requirements for green assets that you want banks to lend more to. Both have problems. I don't think the ECB is going to get there anytime soon. So I think most of what they're going to do is a kind of signaling. They're going to signal to the market that this is important and the market needs to take more notice of this and price these risks better. And they're going to force disclosure to allow the market to price the risks better. And then they're going to hope that the market will work its magic itself without forcing, without leading the market by the hand. But I think the banks will be key to that. That's what I think at the moment.
But if I may add something to what Martin said, I also think that we are not so close to have proper regulation in terms of higher or lower risk weight, depending on whether we are favoring or penalizing, as you said. A supervisor can do a lot informally. So within the SREP evaluation, which ultimately is a capital requirement, it's not a set in stones, and it is for Pillar 1 requirement. But within Pillar 2 requirement, the SREP evaluation, they can really do a lot. And effectively, at the end, it's not that different for banks. So they will force banks very rapidly. But I honestly hope that they will give enough time for the transition, because otherwise we will have abruptnesses that probably are not positive.
I would like to pick up some questions, or at least one from the audience, and put it in short, maybe coming back to the very current situation of COVID and the high uncertainty about what is going to happen in the next few weeks. Will this now end in a couple of weeks, or we have a third wave in Germany? We're very much talking about that. Is the analysis that you did, Martin, and the others at the beginning still valid if there will be another shock? What about risk scenarios? If there's a third wave of corona, what would happen? It's just the case for another round of help from ECB and governments, or will there be a limit to this?
We think it's prudent to be cautious in our forecasts of COVID. We have the UK mutation, the South African mutation, others. It's a very unstable, dynamic virus. We think to a certain extent, even if cases drop dramatically, and hopefully they will, this is going to be with us for years. And, we could have another wave or two, and we should be prepared for another wave or two. But I do think I'm optimistic even in that context, because I think the world has learned a lot about how to cope with this. I think the governments have learned a lot about how to cope with this. I think the medical community, I'm very closely affiliated with some of the vaccine development efforts. There's been a quantum leap in understanding vaccines and viruses over the last 12 months. So even if this wave, if we have a resurgence of cases, I think we've learned so much that we will muddle through.
Elena, I mean, the difference between Europe and the US in that case is also that in the other way around, or the same, that Europe is much less good in terms of vaccination. Elena, what would you think?
Yeah, unfortunately, this seems to be the case, that Europe is much more behind than the US and the UK in terms of vaccination. But hopefully we will be able to catch up once the vaccines will be available. At least Martin mentioned Draghi before. So let me say in Italy that we are assisting a revolution, because now we are going to have vaccinations everywhere. So really everywhere, in schools, in parking, in any place available. So we've not built new places where to vaccinate people as it was the year before, but we will really use any available facilities. And this has been one of the major changes that we have seen in these last days. But going back to what this means for banks, I think I think that the worst scenario is nevertheless behind us. I like to think that we're optimistic. So I like to think that the most severe scenario that was foreseen and that was used by banks in their calculations of how much provision, for example, to set aside, I think is not going to materialize. And I think the SSM also semi-publicly, at least in interviews, has said that. So I think we are beyond that. At least I would like to think we are beyond that.
Okay. Moritz, if there's any other question, I would really like to have another risk scenario, just an answer on that. It seems as if all scenarios in economic financial terms are considering that the low interest rates will continue. Maybe that will be a surprise. What does that mean for European banks?
I can take that if you want. It means that we are going to have lower profitability for longer. That is what it means, basically, in a simple answer. Because we know that low interest rates are, on the one hand, benefit banks because they keep, of course, the corporate defaults low. But on the other hand, they also lower significantly profitability in terms, at least, of the net interest margin. And therefore, the longer this environment lasts, the more banks have necessarily to get profitability from some other sources of their business models. There can be fee income, but there is a limit as to how much fee income can substitute for net interest income, or they need to diversify more from a product perspective. So they need to go more into insurance, they need to go more into other businesses, or alternatively, they need to do more search for yields in order to boost profitability. But that's not the outcome that should be desirable, in particular given the situation. So go for volume lending, basically.
Yeah, even, I think rising interest rates are often a very, very hard thing for banks to manage. And, it usually a short-term issue, but it's a really tough one. So even if inflation stays low, if you look at the last 40 years where we've had a decline in inflation and long-term interest rates and short-term interest rates, nevertheless, all of those factors has bounced around by 100 or 200 basis points every few years. So even though it's been downward plus or minus, 1 or 200 basis points. So I would expect a little bit of a reversal in interest rates over the short term. I think over the longer term, they're going to remain low. That doesn't mean it's going to be easy for banks.
Martin, what do you think?
We're seeing this, particularly in the US, a reflation of the economy. Inflation is the hot topic of financial markets at the moment, and we're seeing inflation return in Europe as well, not to the same extent. But having said that, do I think that means we're going to see some kind of monetary tightening and raising of interest rates in Europe anytime soon? No. I think that this inflation that we're seeing is mostly supply-driven, not demand-driven. I think it's also caused by one-off effects from the pandemic. It doesn't reflect an overheating of the economy. I think nobody would argue that. So I think the central bank will look through, even if inflation rises above its target of just below 2%. I think the ECB will look through it and say this is temporary, and we expect it to come back down next year. And they're not going to start raising interest rates anytime soon. So I think banks are stuck with low interest rates. I think Elena is right on that, and I think they need to cut costs. I think they need to, develop their fee income. I think they need to diversify their business models. I think they just need to get better at what they're doing. And it's not easy, but it's what they have to do. because they can't rely on the ECB raising interest rates to bail them out.
But if I may add, what the ECB could do in case rates remain low, and you see the ECB is doing it a little bit, it can adapt monetary policy if you want to. It can do more favorable TLTROs. It can do more favorable tiering policies. These two are most direct helps for banks. If you look at how much European banks have relied and how many profit actually they have done on the TLTRO is quite significant. So these are powerful instruments. It doesn't make up completely the loss in profitability from the low rates, but it's a big help. So it's not just raising rates that the ECB could do, but it could do other policies while keeping rates low if you wanted to.
Thanks. Very interesting. We're just closing, finishing. I just wanted to throw in a quote, a very exciting one and astonishing one. Maybe, Martin, you have seen that last week from the CEO of Allianz, which is a very big company, an insurance company. And he said, and on Friday, Mr. Bete said that the situation at the moment on the stock markets and in financial markets reminds him very much the situation in 2008, 2009, or 2000 with crazy things happening. That's what he said with Bitcoin, that some celebrities buying Bitcoins, that provokes a bubble and so on. So very briefly, would you think that he's right?
I mean, it's hard to argue that that we don't have some, what was it that Alan Greenspan said, irrational exuberance in financial markets at the moment, particularly in the equity markets. But I don't think that equity prices in some measures are in some multiples of earning expectations are as high as they have been historically. So, whilst we have just come through this record recession, markets are looking forward, investors are looking forward to the recovery, to vaccinations. They're looking forward to a very sharp, what most economists expect to be a very sharp rebound in the global economy this year. And so in some ways, it's hard to argue against it. I do think that there is a danger that asset price bubbles will build up. And that is something that we do need to be aware of. And that there is, there is a danger of irrational exuberance. But the alternative is that, you take the punch bowl away. Central banks take the punch bowl away. They raise interest rates. They try to tamp down these markets using monetary policy, and that's not going to happen. If you hear what Janet Yellen has been talking about, if you hear what Jay Powell has been talking about, Christine Lagarde, they're all convinced that they need to keep financing conditions very favorable, that until the recovery is properly taken hold and the pandemic is over. So, no, I think it's something we need to watch, but I don't think it's a massive concern. And I think comparing markets to, levels of before the last crisis is a little bit disingenuous because it's not a comparable situation.
On this note, I see a very interesting debt talk on asset price bubbles and central bank policy coming up. But we are out of time. I enjoyed this greatly. Thank you so much to all our panelists, and thanks to Thomas, thanks to Elena, thanks to Richard for being with us on this debt talk, and Martin, of course. This concludes it, the debt talks and the new economy shortcuts conversation. Thank you so much again. To view past episodes of the Debt Talk series, click on the Watch All Episodes to the right of this video, or visit the website ineteconomics.org. And you can also follow INET Live at INET Economics to hear about new episodes and information on upcoming events. So see you next time. Thank you so much.